Hello, America. This is Dean Barwick, once again, your host for the Money Talk Show. Hey, this is exciting. We are doing part 2 of mistake number 11 of how to avoid the top 12 IRA and legacy planning mistakes. And again, my name is Dean Barwick. I am your host for the Money Talk Show. I am also the founder and president of Acquire Capital Management. We are a registered investment advisory firm in the state of California. And again, go to themoneytalkshow.com and they will help you find an investment advisor firm in your local area, as well as answer any questions you might have about our presentation. So we encourage you to do that. Well, listen, we left off on part number 1 with strategic asset allocation. If you remember, we talked about the 11th mistake is failure to control and allocate your assets can be disastrous. So we're going to talk a little bit today about the strategic asset allocation. And during our the end of our last segment, we talked about the fact that 93.6% of the portfolio performance in your investments is based on strategic asset allocation. That's strategic allocation among the asset classes rather than picking individual stocks and bonds or trying to time the market. So we're going to go into that a little more today. Let's talk about some allocation options. Now, when you do a 401k rollover, and that is, again, we talked about if you've left your company or your firm and you've got your money in that 401k, you want to move it on with you and do a rollover, there's a couple different options that you have. Number one would be the traditional IRA. You do a rollover into an individual retirement account, and there is no tax penalty. You pay no taxes when you do the rollover. The money continues to grow tax deferred. However, when you take the withdrawals out of that IRA, you will pay taxes. Now, most people today do believe that we are going into a higher tax rate in the future. Based on just the amount of borrowing and money printing that's been taking place and all the wonderful things that has kept this country afloat. I do not have that crystal ball, but I tend to lean in that direction. I don't know how you feel about that. Anyway, with a traditional IRA, like with your 401k, there's tax deferral in the actual account as the money grows, but you do pay taxes when you take the money out. In a rollover, however, there's no taxes paid to roll that over. Now, the second option is a Roth IRA. That's a Roth IRA. When you do the rollover, you will be penalized, or you will pay taxes, not penalized, but you'll pay taxes on today's tax rate, which, ladies and gentlemen, could be a whole lot less than it is down the road. But when you pull the money out, your income that you pull out now is tax-free. Now, the benefit there is this, is if you're going to have 30 years, 40 years of retirement, and maybe you're 5 or 10 years away from retirement, and I can't tell you what to do on this broadcast, but many times sitting down with my clients, we can identify that, hey, it makes more sense to take that tax hit now and pay it now, and take that hit as ordinary income today, do the rollover, and when it grows further down the road and you're taking the money out, you'll actually have made, or you actually will be ahead because that money comes out tax-free. But those are the two options you have, the traditional IRAs or the Roth IRAs, okay? Again, remember, the IRAs give you so many more choices within the IRA. The investment choices are unlimited. So you can do that asset allocation within your IRA much better than you can in the 401k. And you have so many choices on what investment vehicles you're going to use in order to keep the fees down. And that's really important. And that really brings us to our next step. We're going to talk a little bit about one of my favorites, and that is the benefits of ETFs. ETFs are exchange-traded funds. In many ways, they're similar, and I use similar, to a mutual fund. In other words, you have a vehicle that has many different types of investments, stocks, bonds, and so forth within that vehicle. There's buying and selling taking place within that vehicle. However, the model for the exchange-traded funds, or the ETFs, provide lower costs, real-time tracking and trading, diversification, dividend opportunities, and they're optionable. And options are great to produce cash flow. They're cash flow generators. So ETFs are becoming extremely popular today. USA Today reports that ETF assets have grown from $226 billion in December of 2004 up to $322 billion, and this was a Thursday, May 18th, 2006. Okay, so they are becoming very, very popular, and they've become one of my favorites for helping people with their retirement planning. So let's take a look at this. Does your current portfolio provide growth and market participation, meaning that you're participating in the market or in the growth of the market when it goes up, consistent monthly income coming to you, a higher than average overall yield, and downside protection in a bear market? In other words, when the market goes down, you've got a limit to how far you're going to go down. You've set a mark, and that gives you that protection. So let's take a look at how we can use ETFs to do this, okay? This is an ETF strategy, focuses on three core principles. Number one, to provide opportunity for growth and participation in 70% of an up market. So you're going to participate up to 70% of the up market. Second, and that is it generates consistent monthly income with yields that are generally higher than traditional investment vehicles. This income can be sent to you on a monthly basis to cover expenses or desired purchases. If you don't need the income, then you can actually leave it in the portfolio to be reinvested. Now, last and most important, we have the downside protection. When the stock market declines or is extremely volatile, if risk is managed appropriately, our goal is to capture that 70% of the up market, and in return, to realize only 30% of the loss in a bear market. So that's really, really important. And that doesn't mean you lose 30% of your portfolio. That means you only participate in 30%. So if it goes down 10%, you've lost 3%. But if it went up 20% the year before, you made 14%. You actually did pretty good between the 2 years. Okay, so that's one of the ETF strategies we like to use with our clients, and I'm not recommending you jump into anything without speaking to your investment advisor representative or fee-based financial planner, and that, of course, is very important. Now, let's talk a little bit about the exchange-traded fund, or ETF, covered call portfolio, and this is where we're getting some really nice income. It's very similar to a tenant, a landlord type scenario. On this previous slide, we discussed the importance of generating income on your investments. We use a time-tested technique that is widely used by institutions and mutual funds. So this is not something new. We sell what's called a covered call on the ETFs that you own. It's very similar to renting investments that you own. So let's go into that into a little bit more detail. For instance, let's say that we're going to give someone else, well, what that means to you basically is that we will give someone else an investment opportunity to buy your ETF from you at an agreed upon higher price with approximately, let's say, 30 days. So when you sell an option, somebody else is buying that option, and if that exchange traded fund goes up to a specific price, they're going to exercise the option and buy it. So you're saying, okay, I've paid $20,000. I'll sell it at $27,000. If in 30 days it goes up to $27,000, you sell it. If it doesn't, you don't have to sell it. So, but they pay for that right to buy that option. So that's what generates that rent or that income for you. And if it goes up, hey, you sold at the market or at the price that you wanted to sell it at. So it's a win-win scenario. Now, let me give you an example. If you were to purchase an investment property, let's say a rental property in Hawaii for $300,000, and your goal was that in 3 to 5 years you'd sell that property for approximately, let's say, $500,000 and make a profit. Now that's similar to a stock you might have bought. Buy low and sell high. Now, wouldn't it make sense to rent that property and receive monthly income while waiting for it to appreciate? And that's exactly the principle we apply to your investment account. The net result is monthly cash flow and a built-in sell strategy. Now, how many times in the past have you purchased an investment, watched it fall, watched it come back to maybe even go up and then drop back down again? It's almost impossible to know when to sell. Our strategy helps eliminate the fear and greed factor that can ruin your investment return. Now, the key to remember is our active management allows for participation in the upside of the market with downside protection in a tough economic environment. Now, that's something we do at Acquire Capital for our clients. And again, we are an investment advisory firm, or a registered investment advisory firm in the state of California. If you're outside of California, go to the Money Talk Show, go to Advisory Referral, fill the form out, give them your phone number. They'll call you, they'll interview you, and they'll do some legwork and help you find some advisors in your area that are practicing and doing something similar, if that sounds interesting to you. Okay. This strategy, it's a very complex and diverse strategy. Strategic allocation ensures diversification based on your unique risk tolerance, and diversification is the key to risk management, and it's critical, a very critical component to your overall financial plan. The simple way of putting this is do not put all your eggs in one basket. Hey, we have a quick wrap-up question for you here, and this is our money question. What is the first thing you should do when you leave your current employer? You can see it on the screen, but the answer is you take control of your assets. And don't forget about asset allocation. Hey, that's it, folks, for today. This is Dean with the Money Talk Show, and I hope you got something out of today's segment. If you have any questions, please go to Ask a Question on themoneytalkshow.com. They'll get back with you right away, and if we get enough questions on the same topic, they will send you an email when we're going to go more in depth on that specific topic. So listen, America, it was great. You have a good rest of the day, and we